There's four things that I've studied a lot to try to figure out where things are going to be in 2023, because I, like you, want to buy real estate. I'm a real estate investor. I do not believe that inflation will be any lower than 4% in 1 year from today. Right now, we're at 7.1. If you take a look, with 6 rate increases, we only brought it down 2%. This would be a 3%. I think that's a bit of a stretch. I do believe, as we just saw in the chart before this, that the federal funds rate will continue to rise and will be well over 5% in 2023. Right now, it's 4.25 to 4.5, but I think we're going to see a series of 0.5 point and 1/4 point increases as they start to tackle this inflation number and get it down to the 2% mark that they all want it to be. If you take a look at the notes from the December committee and the things that they've said in the prior committees, you'll see that this is a majority vote, that most of these people are all voting for these rate increases to try to tackle inflation. This is not a contentious issue at the Federal Reserve Committee level. I do believe that real estate values are going to continue to drop. We've already seen single-family housing drop, as I've talked about in my prior videos. We are now seeing commercial values drop as we start to see cap rates increase and interest rates increase as buyers are able to pay less to the sellers of many of these big commercial projects. And the last one is this lag effect that I think is going to continue into 2024. And I'm going to give you a little bit of a peek of what I'm going to do in my video for next week. But this is what I'm calling the lag effect. So if you drop a pebble in the pond, you have these reoccurring rings that happen, and that's called precession. If we start with the 9.1 inflation in June of 2022, and we take a look at the 7.1% inflation in December of 2022, in 6 months, we have seen 5 rate increases from that period of time. Now, there were actually 6 because one of these is not included that actually happened prior to June. So the real question is, how long will it take for these interest rate increases to lower the inflation rate? And that, of course, is found in what I call the lag effect. There are different things that are happening at the same time with regard to these interest rate increases: credit cards, automobiles, real estate, refinances, all kinds of things are a result of these rate increases, and they're all happening at a different time. In 2023, what are the things that you can watch and what are the things that you can do? The first one is that you need to be watching some of these foreign buyers as they come into the United States because of our strong dollar. This has happened before because foreign investors will look for the U.S. to park their dollars because the economy is strong. So this is something that you need to watch. The second thing is you can acquire properties with fixed debt. So in other words, debt is now an asset. You can actually minimize your borrowing costs by buying somebody else's debt if you can on an assumable basis. A lot of debt is assumable. So think of it as you stepping into somebody else's shoes. So somebody has a 3% loan on some property somewhere. That is an asset right now. Of course, interest rates are in the 6 and 7% range. And so that is a great way to still buy real estate. You do have to come up with more equity, however, but that debt is now an asset. I did a video on this. You need to focus on your operational expenses and your income for 2023. This year is going to be primary and going to be one of the things that's going to flush out a lot of bad operators. And make sure that you have plenty of cash reserves. The last thing, if you are investing, you want to make sure that you do not have a defined exit. So what that means is a defined exit is if a loan is maturing. So let's say you have a loan maturing in 2023 and the rate is, say, 3 or 4%, you're going to be in trouble because you either have to sell that property to a buyer who has to get a higher price loan, or you might have to refinance and you're going to have a higher price loan. The next thing is managed equity. You might be sitting behind that managed equity, and that equity is going to want their money back, and it might not be an opportunistic time for you to sell based on the current market conditions when we're starting to see some of these prices go down. The third thing that affects me personally are what I would call rising capitalization rates, or cap rates. Cap rates are rising because interest rates are rising. And if you have a defined exit and your cap rate is actually going up, then you might not be able to get out of this property, and all that hard work that you put in before is going to be compromised because of the higher cap rates. So these are all the things that you need to take care of before the interest rates continue to go up, and I believe that they will. And of course, the borrowing costs continue to go up. If you have some kind of variable or some kind of bridge loan, you're definitely getting killed on the cash flow. And that's why these cash reserves and all these things are important to look at right now and start to recapitalize or make some decisions on what you're going to do for 2023, because I don't see this getting any better into next year. And it's really a best time, I believe, to just put your pencils down. So here are 3 strategies that we could do in 2023 that you can do before the end of this year to try to get yourself into a better situation. The first one, we talk a lot about this, but your income must rise higher than your debt. This is very, very important, because right now the cost of debt is going up a lot, but your income must rise higher than debt for you to stay ahead of this. Number 2, evaluate your debt costs. So if you have credit card payments that are 18 or 20%, you need to take a hard look at that and figure out how you can lower that so you're not falling behind, as I talked to you about in number 1. Same thing with real estate. If you have variable rate debt that has gone up a lot, you need to be looking at fixing your debt costs today. You need to hedge your payments today and grow your income for 2023. And then the third thing, which I talk a lot about, cash is king. Do not worry about inflation. Grow your cash savings account as much as you can. You're going to need cash for all kinds of reasons. First, you should always just prudently have a reserve. You should have at least 6 months of operating expenses. 2, you cannot control, unless you own the company, what's going to happen from a corporate profit standpoint and who's going to get laid off next. So you need to have enough cash to buffer you in case you have a job loss and you can go find another one. 3, you need to have enough cash to be able to pay your rent or your housing or whatever else you need to be able to hold on to or sustain through 2023.